welcome to the Providence Investment Update for October 2022. My name is Michael Ogg. I'm a Senior Advisor and Director at Providence. I'm joined here today by Grant Patterson, CIO and Founder of Providence. Welcome, Grant.
Thanks, Mike.
I'm also joined today by Mark Waite, who's a new addition to the Providence team. He's the Head of Investment Strategy. Welcome, Mark.
Thanks, Mike.
Grant, we'll start with you and your crystal ball. Markets have sold off a lot over the last 12 months. The question is, are we there yet?
Well, Mike, I don't think you can ever really pick bottom of markets, certainly at an index level. But before we start having a look at where markets may find a level, I think we've got to remind ourselves of the excesses that we've had over the last few years, which have been quite extraordinary. I mean, the US Federal Reserve, their balance sheet increased by 2.5 times to 8.5 trillion, as you can see in this chart. And also the money supply figure more than doubled during that period of time, which fueled asset price inflation and assets. And you also had government bond yields around the globe declining to absurd levels, which were highlighted by the Austrian 100-year government bond that was issued at a negative interest rate. So I think there's still a fair way to go to unwind those excesses. But we have started to see a readjustment, as you mentioned, in markets. I mean, some of the high flyers, the technology darling ARK fund is down now over 80%. Bitcoin's down over 50%. Tesla is now down 47%. And the traditional 60-40 balanced fund, global fund, is down at its worst level for over 100 years. So we're starting to see some value emerge, but we're still not sure where some of the excesses are still hiding.
Mark, I think that's a good segue to yourself. Bonds are such, they're sort of keystone of investing, the starting point of investing, and bonds have sold off a lot over the last 12 months and interest rates have gone up. Where are you seeing bond markets at the moment?
Well, I think it's important to sort of have a think about what the journey has been. And as Grant touched on, interest rates were pushed to incredibly low levels. So in the US, we've seen the Federal Reserve take rates from effectively 0 up to 3.25%. In Australia, similar story, the RBA was around about 0.1% in terms of official rates, currently sitting at 2.6%. Rates in Australia are seen by the market to move up to around about 4.5%, and in the US closer to 5% next year. And what that's meant is a tremendous repricing in terms of bond yields. So you've seen bond yields in Australia and the US both below 1% last year, and they've now moved up towards 4.25%. And these are really, really big moves in markets. And so when we have a look at it and we say, what has that transcended in terms of returns? If you look at the return for a portfolio of Australian government bonds, that's effectively lost close to 10.5% to the end of September. If we look at a global portfolio of bonds hedged back into Australian dollars, that's lost 14.5% to the end of September. The US high yield market has lost 14% in US dollar terms. And then bottom of the barrel, if you have a look at 20-year plus US Treasury bonds, so the highest quality bonds around, they've actually achieved a NASDAQ type return of negative 35.4%. So that's the journey, looking in the rearview mirror. But now as we sort of look through the windscreen of the car and we look forward, we can see that we've got an environment where government bond yields now have a positive real yield as opposed to a negative real yield. They provide some protection against inflation. And we can see within a portfolio in an environment of potentially slowing growth that bonds will at some point in the future start to play a good role in the portfolio, particularly from the government perspective. And I think as Grant and the team have been highlighting, we're starting to see some opportunities in government bonds. And what that means is we move from an extremely underweight position to start to add a little bit more of that exposure in the portfolio.
So Mark, that flows onto credit as well. So credit's also been sold off and is a defensive part of the portfolio. So what's your view in credit at the moment?
So I think that's a great question, and it really stems from what we've been talking about, which is the discount rate. And when we think about the discount rate, it's government bond yields. And so much like the equity market, where we've got a few concerns around sort of earnings going forward, when we look to particularly the riskier part of the credit market, such as US high yield, whilst the absolute yield of high yield market in the US is 9.5%, which on paper looks quite an attractive figure, we're a little bit cautious because we want to have a look at high level of defaults being priced into the market and a wider spread being priced in relative to government bonds. So there will come a time when there are interesting things to add to the portfolio, but for the moment, in a sort of slowing economic environment, the main focus for us is more in the government bond markets, and we see credit coming a little bit later.
I think just picking up on your point in regards to the slower economic growth, and this relates to the potential value of bonds at this level in a slower growth environment, and also our concerns around credit and earnings for equities. I mean, it is likely, probable, that we will have a global recession, particularly in Europe, quite nasty, and also in the States. Australia looks relatively better positioned, we feel, because of our ability to produce energy and resources and also food. But I think globally we're likely to see quite a significant recession as the US Fed fight inflation at the cost of the economy. And that's going to flow through to much slower growth, earnings decline, higher defaults coming with those higher interest rates. And so that's probably the theme across the whole portfolio, is trying to make sure that we've factored in the difficult economic environment we're likely to see next year and the year beyond.
So Grant, given that, what does that mean for portfolio construction?
Well, I think, Mike, we still need to remain very diversified in our view, and quite defensive, because there's a lot of unknown unknowns out there, and we've been running a fairly diversified and highly liquid portfolio for some time. So I think that's still relevant in the current environment. We're cautious in private markets where the pricing hasn't really been adjusted to what's been happening in listed markets, and a good example potentially is in the property market. The A-REITs have fallen 30+%, now trading at a 25 discount to their underlying NTA at a cap rate of 7, but the unlisted direct market still hasn't adjusted the cap rates, still trading around 5 at around their NTA. So I think staying liquid is still very important, being diversified is still very important, and keeping liquid to take advantage of some great opportunities that are likely to be forthcoming.
And where are you seeing the opportunities? But you've mentioned bonds before, but where else are you seeing opportunities?
Well, as I mentioned, I think the A-REIT sector looks quite interesting, the listed property trusts. I think they've factored in a lot of the bad news at the moment, so that's certainly something that we're having a look at. We do believe that government bonds at these sort of levels look reasonable value. I mean, we're certainly not going to an overweight position because of the Fed hiking cycle that's continuing, but we think at this sort of level, to try and protect the portfolio, that government bonds look okay. We're still happy to own gold as a bit of a diversifier in portfolios, as we are in defensive alternative investments, so there's a bit of value there. We've still been quite happy with the niche property sectors, and now we're starting to have a look at some of the deep value global equities that are trading at reasonable valuations behind the index.
And Mark, just one more thing for you. In terms of hybrids, we're seeing a lot of hybrid issuance at the moment. Are they good value yet, or is there more to go?
I think we tend to put them in the same bucket as when we talked about high yield credit and other areas like that. Yes, we've seen some widening in spreads, but in an environment of a slowing economy, potentially the discussion around bank earnings might start to come in focus, and investors may well require a slightly higher risk premium. As well, they tend to be relatively less liquid than some other parts of the fixed income market. So once again, you might get a little bit more of a liquidity premium.
Yeah, and I think that comment about demanding a higher risk premium is very important. I mean, the discount rate has moved up quite substantially over the last 12 months, yet some of the product that we continue to see to come through to us is still priced at the same level as it was last year. Well, that's not good enough now. We're demanding a higher return from risk assets, and we need to be patient during this period of time, because some distressed assets will become available, and that's where we want to take advantage of those.
Thank you. And is there any update on Providence?
Well, besides the appointment of Mark Waite, who's joined us, which we're very excited about as Head of Investment Strategy and part of the senior executive team, it's great to have Mark on board to bring his global experience to the investment decisions at Providence, so that's wonderful. Zora is leaving us, moving up to Brisbane to follow her chosen career in marine biology, which she studied, and she's working up there with the CSIRO, so we certainly wish saw her very well. We also celebrated our 22nd year in operations. Our licence was granted on the 20th of October in the year 2000, which was quite an eventful sort of period of time. So 22 years on, we're delighted to still be the custodians and helping our clients and families navigate through these very difficult times. And certainly after the year that we've had in challenging and complex investment markets, we're very much looking forward to catching up with all of our clients at the end of year Christmas party later on in the year, and look forward to catching up with everyone in person at that stage.
Thank you, Grant, and thank you, Mark, for joining us. And thank you also for joining us today. I hope you enjoyed the presentation. If you do have any questions, please don't hesitate to reach out. See you next time.